Thank you everybody for joining us today. So there's a big move in what's happening in the markets in terms of how trades are processed and how they are cleared and how they are settled. That is going to begin on Tuesday, next Tuesday, May 28th. It'll start in Canada and Mexico on Monday, but not until Tuesday here because of the Memorial Day holiday. Okay, and what this is known as is T+1. Okay, so right now, most transactions in the financial world are T+2. Okay, however, starting on Monday, they will be T+1. So let's dive into what that actually means and what is going to be the difference. Who cares? Okay, so did everybody know that there's actually a difference between the date you trade something and the date that it settles? Trade date is the trade date, today, tomorrow, whatever it is. And the settlement date is when the transaction actually is finalized. Okay, right now, for most asset classes out there, that is 2 days. The settlement date occurs 2 days, 2 business days after the trade date. That's changing on next Tuesday to 1 day. Now, options already settle T+1. So it's not going to make a difference in the option market. It will make a difference for those of you that trade stocks or ETFs, which do trade right now on T+2. Okay, this is actually really great news for small accounts, cash accounts, day traders. Okay, going to T+1, and I'm going to go through an example and explain why. The reason that the markets are doing this, when I say the markets, I'm talking about the federal, the laws, the governing bodies, the SEC, FINRA, and the like. Okay, the reason they're doing this is they're looking to make markets more efficient, reduce risk, and it will reduce margin. With T+2, okay, that means the period, the payment period, which is called Regulation T or Reg T, you may have heard that from your clearing firm, okay, is reduced by 1 day. What do I mean by that? Right now, the payment, not the settlement, the payment of your transaction is actually settlement plus 2 days. Okay, let me repeat that again. Right now, trades, and again, not options. Options are already T+1, but trades settle in 2 days, which is T+2, and then payment period is another 2 days. That's what your margin is based off of. Okay, so switching to T+1, that payment period or Reg T day, where your margin is calculated, is also shortened by a day. So it's going to be 3 days instead of 4 days. Okay, so as a review here, let's just go through. Transaction date is the day you make your trade. That one is the easiest, most straightforward. Settlement date is when the trade becomes, let's say, official. Okay, so it's the day that if you buy something, it's the day that that payment is due. And when you sell something, okay, it's when that payment is owed to you. Okay, so what does this mean for everybody? What does this mean for everybody? Okay, right now, if you buy a security like a stock or a bond, ETF, okay, your brokerage firm has to receive that payment from you no later than 2 business days after the trade is executed. Okay, under the new rule, the T1, these transactions will settle 1 day later instead of 2 days. Okay, the SEC has done this, as I mentioned earlier. They believe that this shorter settlement window, shortening it by 1 day, reduces the risk that a buyer and seller, somebody on either end, is going to default. That then translates to lower margin requirements for the broker and a lower risk that, high volumes or high volatility is going to force a broker to restrict trades, like what we have seen recently back in the meme stocks, back in DJT about a month ago or so. So it is going to make things more efficient. Now, back in the olden days, when I say olden days, I'm going back 7 years now. Up until 2017, it was actually T+3. 2017, it was changed to T+2. Now it's T1 because the world is faster, because transactions are faster. Okay, so what does it mean for most people? Not a lot. Not a lot. Okay, and remember, for those of us trading options, we're already at T+1. Okay, so let me go through an example here. Okay, let me go through an example. If you are trading a stock, if you're in a cash account. Okay, so why is this good for small accounts? Let's say on Monday, okay, you buy, let's say you have, on Monday, you have $2,000 in your account, okay? And you buy 200 shares of, I'm just going to call it XYZ stock at $10. Okay? You've used the cash in your account, right? That's a total transaction of $2,000, which was what you had in your account. Everybody with me? On Tuesday, next day, you have 0 buying power because of the 2-day settlement, or the T+2. So you literally cannot trade until Wednesday. You cannot trade until Wednesday. With T+1, you can trade the next day. So going from T2 to T1, especially in a cash account like this, okay, you're going from basically being able to trade on, every other day to every day. It's almost like you can trade double as much, twice as much. Okay, so now let's say that the stock rises to $11. Okay, you bought it at 10, it rises to 11. Well, it doesn't matter, because on Tuesday, the value is now $2,200 in your account, but you still can't do anything with it. You still can't do anything. You've got to wait until Wednesday. So this is really, really significant for people that have smaller accounts and cash accounts, because it literally will allow them to be more active in the marketplace. It really increases the amount of liquidity in the marketplace. If you think about it, again, I want to stress this once again. options already settle in T+1. But for those trading stocks or ETFs, this is huge. This is huge. There was a survey done out there, some of the research out there by the, what is the name of this body here, this regulatory, the DTCC, Depository Trust Clearing Corporation. And they, through all their iterations and everything, looking at what the change of T2 to T1 is going to do, they believe it's going to lower margin requirements by 41%. Well, if that is really the case, you can imagine how much more liquidity is going to be in the market. More liquidity in the market gives us more efficient markets, theoretically. Theoretically. The big thing, I think, for us as option traders is when we do get into one of those situations of trading a hard-to-borrow stock, a meme stock, whatever it might be, okay? Those stocks, when you cannot borrow them from your clearing firm to sell them short, or if you do, you have to pay astronomical fees to do that, those fees should be cut dramatically, which in turn, if those fees to borrow the stock are cut dramatically, what do we know about the option markets in these hard to borrow stocks like a DJT or so? We know that the puts are always much more expensive, right? Because if you were going to sell a stock, okay, if you're just going to sell a stock outright, you're looking for the stock to go down. What can you do alternatively to that is buy a put. Well, if you're selling a stock, but your brokerage firm is charging you a massive, massive amount for that, reducing the price, the effective price that you're really receiving for the stock, well, that has to be represented in the option market. Okay, let me actually go here for a second and see if we can bring something up here in DJT that would represent that. Everybody see DJT? There we go, Autodesk. Awesome. Awesome, awesome. Take some of that risk off. All right, everybody see DJT on the screen right now? And we had done a review on this. We had gone through a discussion a few weeks ago, and we can reference that video again. Okay, but let's look at the at-the-money options that expire next week. Okay, so the stock right now is trading roughly 45. Let's key in on, actually, we can look at right at the 45.5, because there are $0.50 strikes. And why is the put price so much more expensive than the call price? Right? We know that if we're looking at the money options, that the call and the put should be really close together, right? Unless there's a dividend, which there's not here. But here you can see that the put price is $1 more, which on a $2.50 option, you're talking about the put price is actually priced 40% higher, approximately, than the call price. Does that make sense to everybody? Comparing these two prices? Why is that? It's not because the market is biased to the downside. It's not because the market is really bearish in this stock. It's because if I went to sell stock, or if anybody went to sell stock at 45.5 right now, your brokerage firm, because the stock is hard to borrow, is going to charge you an arm and a leg. What's that arm and a leg? They're basically, for the next, today is the 22nd, right? So for the next 9 days till expiration, okay, they're charging you essentially an extra buck, buck and a half. So instead of theoretically getting your short stock at 45 and a half, if that's where you were selling it, because of the expense, the fees they're charging you because that stock is hard to borrow, they're taking $1, $1.50 out of that, and your effective price, let's say, is $44. That is why puts are more expensive than calls in DJT. Those margins now, because of the risk with T+2, okay, because of that risk, there's that 2-day window that, brokerage firm is taking a risk about not being able to get this transaction settled. The fact that's now going to go to T+1, that hard to borrow, because that risk is now cut in half, is going to come down. Is it going to come down commensurate and be cut in half? I don't know. That's something for the brokerage firms. But that hard to borrow fee is going to come down because the counterparty risk is lessened, which means that the option markets on a stock like this will start to come a little bit more in line. There's still going to be a premium on the put side, but they will start to come in line a little bit more. For most of you, probably is not going to make a difference in what you're doing. It really isn't. But if you are trading stocks, if you've got a smaller account, if you're in a cash account, whatever it might be, you are opening up, or this is opening up, a lot more liquidity for people. What's the end result going to be? I mean, there's going to be all sorts of data that's accumulated, and, whether it's after a week, a month, 6 months, to see what kind of liquidity, what kind of efficiency this actually brought to the market. We'll have to see. But that's why this T+2 to T+1 is so important. Now, there's also one other risk to this. And it's not risk for us. Okay? This goes into effect for the United States, Canada, Mexico, and I believe the Argentinian markets. European markets, Asian markets are still on T+2. That is going to be an issue for them, because if you think about any transaction we're making, if it's in a different currency, everything has to be converted over to the dollar. Okay? Not that the dollar fluctuates a ton on a daily basis. It can, but even a small fluctuation in the dollar, when you're talking about foreign currency exchange and billions upon billions of dollars of transactions a day coming out of Europe, Asia, wherever it might be, there's a lot more risk those people have until they eventually change to T+1. I know the Indian markets in India, they're already on T+1. I think they are the only major market that is already on T+1. All right, guys? I would be surprised if you didn't get some notices from your brokerage firms over the next few days about this new settlement process taking effect next Tuesday.